Who protects your money if a bank fails? Imagine waking up tomorrow morning like any other day. You grab your phone, open your banking app to check your balance, and get ready to pay a few bills. But instead of seeing the number you're used to, a single message appears on the screen. This bank has been closed. You refresh the app. Nothing changes. You pull out your debit card to buy your morning coffee. Transaction declined. You try logging in on your computer. The website won't load. Suddenly, your heart starts beating a little faster. Your paycheck is supposed to arrive this afternoon. Your rent is due tomorrow. The money you've spent years saving suddenly feels unreachable. The first question that pops into your mind is probably the same one millions of people have asked throughout history. Did I just lose all my money? It's a terrifying thought. And the scary part is, this isn't just something that happens in movies. Throughout history, many large, respected banks that seemed too big and too stable to fail, have collapsed. Some were operating normally at the beginning of the week, only to shut their doors a few days later. News spreads everywhere. Television stations interrupt their regular programming. Social media explodes. And somehow, that one friend who still owes you $20 suddenly becomes a banking expert overnight. It's funny how financial experts seem to appear whenever a bank makes the headlines. But here's where the story takes an unexpected turn. Even though many banks have failed, millions of customers have recovered almost every dollar they had saved. So if the bank went bankrupt, who paid them back? Was it the government? The central bank? Or is there a hidden safety system quietly protecting your money without most people ever realizing it exists? And if that system is real, why do people still panic every time they hear rumors about a bank getting into trouble? The truth is that governments around the world learned a painful lesson many decades ago. The biggest threat to a bank isn't always a lack of money. It's a lack of trust. Because the moment people stop believing their money is safe, they all tend to do exactly the same thing. They rush to withdraw it. Ironically, that reaction can create the very crisis everyone was trying to avoid. Think about a crowded movie theater. When the movie ends, everyone calmly walks toward the exit, and everything is perfectly fine. But if someone suddenly jumps up and shouts, "Run!" almost nobody stops to ask why. People run first and ask questions later. Human psychology works that way. And believe it or not, banks work in a surprisingly similar way. They're designed for normal days, not for millions of frightened customers demanding all of their money at exactly the same time. So what really happens if your bank suddenly fails? Who steps in to protect your savings? Does the government automatically give you all your money back? Is there a limit? And are all bank accounts protected equally? The answers might completely change the way you think about banks. In fact, they all begin with one of the worst financial disasters in modern history. A disaster that forever changed the banking system and led to the creation of one of the most important financial protections in the world today. The story begins nearly a century ago, during one of the darkest periods in economic history, the Great Depression. In the early 1930s, thousands of American banks failed. Surprisingly, many of them weren't hopelessly bankrupt. They hadn't suddenly lost all of their money overnight. Instead, millions of frightened customers rushed to withdraw their savings at the exact same time. Imagine owning a successful restaurant with plenty of food, loyal customers, and a healthy business. Then one morning, every customer you've ever had walks through the door at exactly the same moment and orders lunch. No matter how well your restaurant is managed, you simply couldn't serve everyone at once. Banks face the same impossible situation. The real problem wasn't always bankruptcy. It was something economists call liquidity. Liquidity simply means having enough cash available right now. A bank may own billions of dollars worth of valuable assets, including home mortgages, business loans, government bonds, and investments. On paper, it's financially healthy. But those assets can't instantly become stacks of cash sitting behind the bank counter. It's a little like owning a beautiful house worth $1 million while having only $20 in your wallet. You're wealthy, but if someone asks you to pay $50 immediately, your house doesn't magically turn into cash. Banks operate in a very similar way. When you deposit money, it doesn't simply sit inside a giant vault with your name written on it. Instead, much of that money is lent to families buying homes, entrepreneurs starting businesses, students paying for college, and companies investing in new equipment. That's one of the reasons modern economies are able to grow. Your savings are constantly helping someone else build their future, while your account balance remains available whenever you need it. Under normal circumstances, this system works remarkably well because not everyone withdraws their money at the same time. But then fear enters the picture. One worried customer hears a rumor and decides to withdraw their savings. Another person sees the growing line outside the bank and thinks, maybe they know something I don't. Television cameras begin showing crowded bank branches. Videos flood social media. Suddenly, people who never intended to withdraw their money start driving to the bank anyway. Not because they're certain the bank is failing, but because they're afraid everyone else will get there first. Fear spreads faster than facts, and within hours, a perfectly healthy bank can find itself struggling to satisfy an overwhelming demand for cash. Economists have a name for this phenomenon: a bank run. Ironically, a bank run is one of the clearest examples of how individually rational decisions can create a disastrous collective outcome. Every customer believes they're making the safest choice by withdrawing their money. But when millions of people make that exact same decision at the exact same moment, they can create the very crisis they were trying to avoid. The bank doesn't necessarily fail because it made terrible investments. It fails because confidence disappears faster than cash can be provided. After witnessing this disaster during the Great Depression, governments around the world realized something incredibly important. If they wanted to prevent future financial catastrophes, they couldn't simply rescue banks after panic had already started. They had to stop the panic before it began. That meant giving ordinary people a reason to stay calm, even if their bank ran into trouble. And that decision led to one of the most important financial protections ever created. It wasn't a new currency. It wasn't a new type of bank. It wasn't even a revolutionary investment strategy. It was something much simpler, but far more powerful. A promise that if your bank failed, your savings wouldn't simply disappear. That promise is called deposit insurance, and it has protected millions of people for generations. But what exactly is deposit insurance? Imagine leaving your car in a secure parking garage. If something unexpected happens to the garage, you don't automatically lose your car. The garage has systems in place to protect it. Deposit insurance works in a very similar way. It's a government-backed protection program designed to safeguard your bank deposits if your bank fails. In other words, if your bank can no longer return your money, another institution steps in and pays you back, up to a certain insured limit. That single promise has transformed the way people think about banks because it removes the biggest reason to panic in the first place. In the United States, that protection comes from an organization called the Federal Deposit Insurance Corporation, or simply the FDIC. It was created in 1933, right after thousands of banks collapsed during the Great Depression. Before the FDIC existed, hearing rumors about your bank could be enough to make you sprint to the nearest branch. Today, if your deposits are within the insured limit, you know your money is protected even if the bank itself disappears. That simple guarantee has prevented countless bank runs over the past 90 years. Here's something that surprises many people. The money doesn't come from taxpayers every time a bank fails. Instead, banks themselves pay insurance premiums into a special fund while they're operating normally. You can think of it as thousands of banks contributing to a giant emergency savings account. Most of the time, nobody even notices it exists. But when one bank gets into trouble, that fund is there to protect customers. It's surprisingly similar to car insurance. You hope you'll never need it, but you're very glad it's there if something goes wrong. Of course, deposit insurance doesn't cover unlimited amounts of money. Every country sets its own coverage limit. If you have more money than the insured amount in a single bank account, the portion above that limit may not be fully protected. That's one reason why large companies and wealthy investors often spread their money across several different banks instead of keeping everything in one place. It's not because they expect banks to fail every day. It's simply a smart way to reduce risk. But deposit insurance isn't the only safety net protecting the financial system. Imagine a safety net underneath another safety net. If one layer isn't enough, there's another one ready to help. That's where the central bank comes in. When a healthy bank suddenly faces unusually large withdrawals, the central bank can provide emergency funding to help it continue serving customers. This doesn't mean it's giving away free money or rewarding bad decisions. Instead, it's buying time for the bank to meet customer demand without being forced to sell valuable assets at bargain prices. Think of it like a hospital emergency room. When someone arrives with a serious injury, doctors don't immediately rebuild the person's entire body. First, they stabilize the patient. Once the situation is under control, they can begin the longer process of treatment and recovery. The central bank plays a similar role during financial emergencies. Its first priority is to keep panic from spreading throughout the entire banking system. Because history has shown that fear can spread from one bank to another much faster than any financial problem itself. That's why economists often say that banking is built on trust as much as money. Every morning, millions of people use debit cards, transfer money online, receive paychecks, and pay bills without thinking twice about whether the system will still work tomorrow. That confidence is what keeps the entire financial system running smoothly. The moment trust disappears, even the strongest institutions can come under enormous pressure. But when trust remains strong, most people never even notice the invisible protections quietly working behind the scenes every single day. So what would actually happen if your own bank failed tomorrow morning? Surprisingly, the answer is much less dramatic than most people imagine. In many cases, you wouldn't even need to stand in a long line outside the bank or desperately try to withdraw every dollar before everyone else. Financial regulators usually step in as soon as they determine that a bank can no longer operate safely. Their goal is simple: protect depositors, maintain confidence, and prevent panic from spreading to other banks. If your deposits are fully covered by deposit insurance, the process is often faster than people expect. Depending on the country, another healthy bank may take over the failed bank almost immediately, allowing customers to continue using their accounts with little or no interruption. Sometimes you might receive a new debit card, log into a different banking app, or notice that your account now belongs to another institution. In many cases, people are able to access their insured money within just a few days. That's a lot less dramatic than Hollywood would have you believe. There are no vaults exploding, no helicopters carrying away bags of cash, and hopefully no one screaming, "The money is gone," while dramatic music plays in the background. However, there is one important detail that many people don't realize. Deposit insurance has limits. If you keep an amount that exceeds the insured coverage in a single account, the money above that limit may not be fully protected if the bank fails. That doesn't automatically mean you'll lose it, but recovering the uninsured portion could take much longer and may depend on how much money is recovered from selling the bank's remaining assets. That's why many businesses, large investors, and wealthy families don't keep all of their money in one place. They often spread their cash across multiple banks, not because they expect disaster every week, but because diversification reduces risk. It's the same reason people don't keep every valuable thing they own in one tiny box. There's another common misunderstanding worth clearing up. Some people believe that keeping large amounts of cash at home is safer than leaving money in a bank. At first, that idea sounds reasonable. After all, if the money is under your mattress, nobody can freeze your account. But your mattress doesn't earn interest. It doesn't protect your savings from inflation. It certainly doesn't call the police if someone breaks into your house. And unless your mattress has somehow learned cybersecurity, it can't protect you from fire, floods, or theft either. Banks exist because, despite the occasional headlines, they remain one of the safest places to store money in modern society. The real lesson isn't that banks are perfect. They're not. Banks can make mistakes. Some banks fail. Financial crises still happen from time to time. But the banking system has evolved tremendously over the past century. Every major crisis has forced governments, regulators, and central banks to improve the rules, strengthen oversight, and build better safety nets. Today's banking system is far more resilient than it was during the Great Depression. Not because banks can never fail, but because the world has learned how dangerous panic can be. In the end, banking has never been built on giant vaults filled with everyone's cash. It has always been built on something much more powerful: confidence. Every time you swipe your card, transfer money online, receive your salary, or check your balance, you're participating in a financial system that depends on millions of people trusting it at the same time. That trust allows money to keep moving, businesses to keep growing, families to buy homes, students to attend college, and entire economies to function every single day. So the next time you hear dramatic headlines about a bank getting into trouble, don't be the person who believes every rumor within 5 seconds. Take a moment to understand what's actually happening. Ask whether deposits are insured. Look at the facts before following the crowd. Because history has shown us something fascinating. In banking, fear can spread in minutes, but knowledge is what protects you in the long run. If you enjoyed this video, don't forget to like, subscribe, and join Money Decoded, where we break down the world's biggest financial mysteries into simple, easy-to-understand stories.